Let's get to the floor show and JP Morgan Asset Management's global strategist, David Lebovitz. David, so glad you're here, especially on a day like today. Certainly hopeful news if it is end up being true that Iran is open to coming to the table with the U.S. Should investors bank on that? Because we've kind of seen this movie before where hopes are climbed and then, boom, they are just dusted.
So anytime we look at a geopolitical conflict, we try to think about the channels by which it could impact the economy. And we don't really have an edge in predicting these types of negotiations, but where we do have an edge is thinking about, okay, what do higher energy prices, what does more government spending, things of that nature, what does that mean for the outlook for growth, and how does that translate to the markets? And so, I would love to wake up tomorrow and have resolution in the Middle East, but unfortunately, I think some of the damage has been done, and it's going to take time for energy prices to come back down here. There are questions around how far energy prices will decline. Can they get back to the mid-60s where they were prior to the conflict? And more importantly, the longer that energy prices are elevated, the greater and more significant tax that is placed on the consumer. So it would be great to see some sort of resolution here, but I think that there are a lot of more fundamentally related questions that need to be answered before we have conviction that we can really sound the all clear.
So I'm hearing you say investors should keep their defensive crouch?
So we're modestly pro-risk. We think that in this environment, managing the volatility is the most important thing. And so we have brought down risk across portfolios, but we are by no means neutral. We're leaning into select markets like U.S. tech, which has sold off aggressively this year, as you noted, where we think the fundamentals are still fairly robust. And we think it could be, frankly, a somewhat defensive trade on a go-forward basis. So still owning risk, but not with the same amount of size as we were coming into the year.
Well, tech is pretty strong today. Obviously, we've got so many tech stories, what with Amazon, Marvel, NVIDIA, and that I get. I understand it. But are you into the hyperscalers? Is that an opportunity that you still see as really fertile?
So some of the hyperscalers do look interesting. Where we've been spending more and more of our time is thinking about more of the picks and shovels of the AI trade, the data centers, the GPUs, the fiber, so on and so forth. So we're playing it from lots of different angles. And I think the important thing for investors is that there are names other than the hyperscalers that you can own to access what's happening in that trade.
The Iran outcome still unclear rather, and the picture's still murky. Can you give me a sense of how you feel about the bond market and if there's any area that you think is really good to go into right now?
So the bond market's a little bit complicated because I think coming back to our fundamental view, the question that we're asking ourselves is how significant will the hit to growth be and what does all of this mean when it comes to inflation? The worst case scenario for both equities and fixed income would be an environment of stagflation, so not a lot of growth with elevated price growth. That is not our base case. When we look at the bond market today, I mean, frankly, valuations haven't moved in fixed income the way that they have in, say, the equity market. So we're neutral from a government bond perspective. We're neutral from a high yield perspective. But where we are continuing to see opportunity is in the securitized space, and particularly those bonds that tie back to the consumer. We recognize that the consumer may have a bit of a drag on them going forward from higher energy prices, but the labor market remains healthy. We came into this year with a consumer that was looking pretty good. And so looking around those securitized structures for us is the most fertile hunting ground today.
What's your blood pressure level on private credit names? That has given the market a bit of a scare, completely separate from the war and tariffs and everything else.
Well, it's funny how we were talking about private credit and that was dominating the narrative, and then, what a difference a day makes. And so when I think about private credit, what we're dealing with here is really a software problem, and more specifically a private equity problem. You had a lot of deals done a couple of years back at valuations that didn't make sense. Too much leverage was put on these deals. Now you're seeing the business models get called into question, and that's leading to estimates of more modest earnings growth and obviously some challenges in that sector. But as a prior guest was saying, not all private credit is created equal, and private credit has a software problem. Private credit, in our view, does not have a credit problem, and that's a very important distinction to make, particularly given the macro shock that we've just been hit with.
Yeah, and a quick mention to our viewers, gold is actually having a decent day. It's been a little bit of a rough go. It was in a bear market. We do have gold moving higher by a couple of percentage points. David, so great to see you. Thank you so much.
Of course. Thanks for having me.